I think it's really important to understand what game you're playing at any given point.
When we first connected, I was a little bit of a fanboy because I love the Promote Pod, which Will is the co-host of. But Will also does real estate for a living.
I now run my own platform focused on the multifamily and industrial with a focus really on South Central Pennsylvania, Maryland, and Delaware. Everyone looks at the same reports. Everyone's like, wow, like, you know where people are moving? Texas. Like, of course, everyone knows that. What I really like to focus on is what's the second derivative of that? Where are places where is the rate of demand increasing?
The cost of capital is so expensive. You can't just flip in, flip out anymore. They're looking at, instead of what your IRR may look like, it's like, hey, what's your year one cash on cash? What's your cash yield going to look like? What are the metrics today? That's more in favor now than ever.
The big thing, it just comes down to risk reward. You have to figure out a way to get paid more than the risk you're taking.
We have our pipeline meetings, and every time we go through a deal, we're never talking about why it's a good deal. We're always talking about, hey, here's the deal, here's the red flag on it. We start with the red flags all the time.
Zach Greinke, he would come to our practice and play catch with this guy. Let's play catch with Greinke. Greinke's like, what's your program? He goes, oh, I just do the program they prescribed to me. He's like, oh, so you're doing what everyone else is doing? He goes, yeah. He goes, are you that much more talented that you can do what everyone else is doing and still make it? He's like, no.
All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem. Today we got Will Krasne.
Hey.
Will, how's it going, man?
I'm well. Glad to be here.
It's good to have you on. It's, when we first connected, I was a little bit of a fanboy because I love the Promote Pod, which Will is the co-host of. But Will also does real estate for a living. He's not just a podcaster. I'm not just a podcaster. We're in the CRE space, and today we're going to talk a little bit about what Will's busy with, what you're up to, and some of your investment strategies. When I listen to the Promote, we're talking about all the big guns. We're talking about all the guys in the news. But here we talk a little bit about what Will Krasne is seeing out there and what you're busy with and some of your CRE insights. So it's good to have you on.
Thanks for having me. Thanks for listening to the podcast. Thanks for the kind words. It's all due to my co-host to 10. I just drag him down.
You guys are like Kobe and Shaq out there with the Promote Pod. Like, you guys are.
I don't know. We don't hate each other though, so that's at least you're.
I mean, you're putting up stats on the court. I don't know how it is off the court. So
no, it's good off the court too.
If it's good off, then maybe it's like a LeBron D Wade or something like that. Yeah. But you guys are putting stats out there, and it's awesome to listen to you guys, and honor to have you on.
Well, thank you. Thanks. It's great to be here.
So, Will, maybe give the audience a little bit of a quick background. What Spectre's busy with and what you're up to.
Sure. So just my 30-second background is I was in institutional private equity at the Carlyle Group and Starwood Capital Group, doing multifamily and hospitality acquisitions and asset management, and then spent the next 5-6 years building out a private real estate platform focused on multifamily and industrial assets in the Mid-Atlantic, and dealt with a family office there. And I now run my own platform focused on the same types of assets, so multifamily and industrial in the Mid-Atlantic, with a focus really on South Central Pennsylvania, Maryland, and Delaware.
And you moved out to Delaware. You're in Delaware now, right?
Yeah, we did. So I shanghaied my wife into leaving New York and moving down to Delaware. So I bought a multifamily property last year, and I have more in the pipeline. We're delivering on a BTR asset later this spring. And so my wife was kind enough to move down here and let me be closer to the assets and get everything set up so that I wouldn't have to be, driving back and forth on 95 twice a week. So it's been much better being down here.
That's real dedication. We own across the nation and we're in different markets, but it's definitely something different to be right next to the asset or close by to the asset. What was kind of the driving force that kind of differentiated you from, hey, I'll just buy in this and in this market and visit once a month to, hey, I need to live here and visit the property and be more hands on?
Well, I think more broadly, you just taking a step back to answer the question, I think it's really important to understand what game you're playing at any given point. And you guys obviously have a bigger platform. You've got, access to quite a bit of capital. You're nationwide. If you are coming out and trying to build that, it's almost impossible to raise capital. Just like a general, like, hey, trust us, we're smart. And, I can cover every market nationally. Like, that's a really hard sell. And so for me,
Hmm.
trying to build my own business, I figured, all right, I can't be everything to everyone. I'm going to try to be like one or two very specific things and then take the bet that I can convince capital to come with me versus, trying to go to markets where everyone else is, where I can't compete on cost of capital, on scale, on, I'm not vertically integrated. And, part of that was just saying, like, I know the market because I live here. And, it helps that I invested in this market because I think it's a very attractive place to live. And, it, I think helps folks get comfortable with it by the fact that, like, I'm here every day. We moved my young kid, our dog, my in-laws live down here. So, we are very focused on these markets. I know the scuttlebutt, I know the traffic patterns. And, that's not something that's scalable. But at this point in my career, I need to put up numbers. And I just felt that the best way to do that was to find a market that had really appealing demographics, really appealing supply demand characteristics, and then just try to brute force the returns. And that's sort of why I'm here.
Yeah, I mean, you got to find your edge somehow, and that's probably one of the best way to do it is, hey, I live and breathe and do everything in this submarket, and I know, as you said, know the traffic patterns. This is why I think this property on this cross street is the place to invest. Talk to me a little bit about some of the submarkets that you're bullish on right now in the Mid Atlantic, and what is the key metric that's kind of getting you excited about some of these different pockets you're investing in.
Sure. And so again, take this with a grain of salt because I'm absolutely talking my own book here, but I'm really excited about South Central
By the way,
Pennsylvania.
that's what this pod is, right? You
Yeah.
get someone on, they talk their own book, and the audience gets to
I
decide
just want to be upfront
what they
about
want.
it. Yeah.
Yeah, for sure, for
Uh,
sure.
So I'm really bullish on South Central Pennsylvania, specifically in the industrial space. So part of the reason for that is industrial has obviously exploded nationwide over the last 5, 6, 7 years, and even frankly a little bit earlier than that. But South Central PA is sort of it's I think the eighth largest by square footage market in the country. But if you go to CBRE, JLL, Cushman and Wakefield, all of the brokerages define Central Pennsylvania differently. Like it's hard to get anyone to agree on like what the actual market is, which to me is an opportunity because if you are just looking at the research reports and saying we got to be in a top X market, it's a lot harder when the market isn't defined the same way. Like everyone knows what the Inland Empire means. Everyone knows what South Jersey means. Not everyone sort of understands Central PA because like some might say that's Philadelphia, some might say that's Pittsburgh. It's not. Like it's Harrisburg, Lancaster, York, maybe Reading, like some of the other ones. So those markets have much lower property taxes than like competitive product in South Jersey or around Philadelphia. So and the rents are 60% of what Class A is in those markets. And so if you're looking for overall occupancy cost for a tenant, it can be half of what you're looking at if you're in South Jersey. So if you're a tenant and you don't have to be right at the port of Newark or right at the port of Philadelphia, you know, you can be half as expensive in Central PA. And so we've seen a lot of tenants move into the market because you can get the same product again at half the price. And if you're a 3PL, like the salad days are kind of over. Like you got to
Hmm.
compete on price. And so the way to you can make your savings is on the real estate side. So you can pay $9 a foot for brand new, amazing Class A space in a great location with the same connectivity, or you can pay $16 a foot in South Jersey and another 150 a foot in property taxes above what you pay in Central PA. So we've seen that. And also, because the rents are lower, it's really hard to make new supply work, especially below, call it 100,000 square feet, because you can't spread the soft costs across enough space. So, it kind of costs to build what it costs to build. Like the land prices are really what's different. And so if the rents are lower, it just makes it harder to pencil. So you have less supply, you've got growing demand, and that's a pretty good equation.
Yeah, it's interesting, just how you were saying it before as like a emerging operator, you gotta play around the fringes a bit with some of these markets and understand the nuances to it. And it looks like you found and carved out a nice niche where, as you said, the definitions of the submarkets have kind of caused some gray area where you can play around the fringes there and get a little bit of an edge on property taxes, where the nets are going to be lower to your tenant. What's interesting is on the supply side, you're even seeing that in some markets pre rate hike in multifamily, where there were low supply on paper, but then if you got crazy rent growth, the supply just flooded in.
Mhm.
But it sounds like for you, it's maybe the barriers aren't there right now in industrial, but are you a little bit concerned of like if rents just skyrocket, hey, like now industrial is going to start popping up next to your properties? How are you kind of accounting for that?
So the stuff that I buy is smaller. So we buy 30,000 to 100,000 square feet. And those are really, we service the million square foot Amazon, FedEx, Chewy, super tankers, because each of those buildings creates an economy sort of all to itself. Because like the packaging companies aren't going to want to do like the off the run packages for the million square foot Amazon warehouse. They're going to sub that out. You're going to need like HVAC supply company to service all these buildings. Those are the types of tenants we're going after. But more broadly, like industrial versus multifamily, like your leases in multi are a year. And so if Graystar sticks up an apartment complex next door and they're charging 2 months for free rent, you know, people are just going to go to that. Like
Mhm.
industrial again is like kind of a commodity. Like the location is really what the barrier is. But if you have a million square foot building leased to Amazon and then someone builds a spec million square foot next door, like Amazon can't leave. I mean, they can go
There's no
dark, but like
concession hopping in
yeah.
industrial.
Now
Yeah.
there is on the worker side because what can happen, what I've seen happen is if you're in a warehouse and you're hiring people at like, $15 an hour, and then the warehouse across the exit hires at $16 an hour, like those people can leave. And that can make it a little bit more difficult. And it makes it less desirable for tenants to go there because labor availability is one of the hardest things. So it's not just looking at like industrial market, like is the industrial market hot? You also have to look at can people afford to live there? Like, can people hire? Like, is it a good place to live? Because if you can't hire the labor, then the tenants eventually can't come. So that's part of what we see in Central PA is it's a nice place to live and like good public schools, commutable, not super expensive. I mean, it's gotten relatively more expensive, but compared to Philly, Baltimore, DC, um, South Jersey, it is very affordable. Um, and so we've seen people move there because they know they can hire.
And is this, I guess, is this where the multifamily part of Spectre comes in, where you start also looking at some of the multi opportunities and your lens in industrial allows you to kind of understand the affordability ratios on the
Well, I think
multi side?
well everything is intertwined, right? Because the rooftops on the industrial side mean jobs, and jobs supports housing. So like that's why I like doing a little bit of both. One, I think again, they're just differentiated business plans. Like the industrial stuff is much more of like high octane, shorter duration. Like those are 3 to 5 year holds. Like let's get in and out, buy something vacant, fix it, lease it, sell it, or buy something with mark to market, like burn off the mark to market, sell it. Multifamily is more like medium, long term holds, and that's more like durable cash flow, less heavy value add. Like that's sort of more of the strategy there. But having both, again, they really tie into each other because you know you need housing for people to build industrial because you need workers, as I said. And then if you have industrial growth, you're going to have job growth, which means housing can uh, housing can perform well. But really, it's about figuring out where like all of these things are commodities, as I said. Like every apartment community, for the most part, outside of like 8 Spruce in in Lower
Mhm.
Manhattan, like designed by Frank Gehry, like is a commodity. And above a certain demand level, like the only thing that matters for medium to long term rent growth is supply. And if you're in, you know, again, talking about a book, but like everyone can look at a census data, everyone looks at the same reports, everyone's like, wow, like where people are moving, Texas. Like, of course, like everyone knows that. But what I really like to focus on is like, what's the second derivative of that? So where are places where not only is the demand, like the nominal demand is less important, but like, is it is the rate of demand increasing? So like if population growth is 50 basis points, but the last 3 years it's been 120 basis points, and it's getting better. That's a way to kind of front run supply. So, and again, like these are the things you have to do when you can't compete on cost of capital, when you can't compete on scale. Like,
Right.
someone else can buy you know, if you own 20 assets in Texas, like adding one more is like much cheaper for you than it is for me to like go to a new market. So it's just, again, it's all about trying to figure out what game you're playing and like how can you generate the returns above market beta.
Well, I feel like the supply side story is now it's more in favor now than ever because rates are higher and people aren't can't really pencil building as much, and the supplies already just hit these high demand markets that you're seeing the blood on the streets and you're seeing the distress a bit because of the supply wave that hit that can't be absorbed. You're seeing the Austins, you're seeing the Denvers, you're seeing these parts of Texas that are getting hit on the supply side. And so yeah, so these high demand markets that people used to track of oh, where are people moving to? Where are people moving out of? Now it's, hey, where is there less supply that needs to be absorbed? And as you said, second derivative order of thinking, the Mid Atlantic is one of those places. The Midwest is one of those places. The
Yeah.
Bay Area is one of those places. So I think you're looking at it on a right lens, and there's something to be said about these low supply markets that maybe they're not jumping off the page on inbound migration, but they're resilient during times where you get these crazy rent growth and then the supply follows and you can get pounded on net effective rent because of it.
Yeah, for sure. And again, there's no free lunch here. It's not like I've solved investing. Like, there's not as much
Right.
liquidity, right? Like, if you're in Texas, or if you're in Arizona, if you're in Denver, like, there's always a bid to take you out. May not be like right now at a number you like necessarily, but like, there's a bid. Like, you can go get,
Hmm.
BOV, and if you're priced correctly, you'll have 10 offers. Like, that's not always the case in some of these other markets where I'm in. So you've got to be okay being in there for the longer term, which, not everyone is, which is, depends on your capital. And again, but I totally agree with you that it's really about what's the supply story, because we forget about that part of it. Like, everyone wants to focus on the demand because that's how you get people excited to invest with you. It's like, this place is growing, it's popping up. Like, whereas if you'd bought something in, you know, like pick a market in like Illinois, Wisconsin that have been like really strong performers. Like, people are maybe less excited to go invest in La Crosse, Wisconsin, but if there's no supply and you've printed like 4% rent growth last year, like that's as good as anywhere nationally. I mean, some of the markets I'm in, I mean, I guarantee you've never heard of any of the towns that I own multifamily in. You'd be astounded if I told you what our year over year rent growth was. Um, it's just, again, because there's no supply. It's not because anything else than that. We have positive growth and no supply, and that's just as good as incredible demand, but then followed with incredible supply.
Yeah, and I mean, if you zoom over the Northeast and Mid Atlantic, and you just see like market to market vacancies, they're all sub 10%. And
Mhm.
then you zoom over the Southeast, and you'll be lucky if you see anything single digit vacancy factors. I mean, the fact of the matter is, sub 90% vacancy is very casual in the Southeast and the Sun Belt, whereas in these Northeast, it's just 5% as usual as people were underwriting.
No, totally. And again, like, you didn't capture as much of the upside in some of these markets as you would elsewhere, right? Like, you didn't see the 17% rent growth in Harrisburg, Pennsylvania that you did, in parts of the Sun Belt, or most of the Sun Belt, I should say. But again, you don't have the downside. And the way the compounding math works is that if you don't have, like, not having negative growth is really, really important. Like, the most important thing for long term compounding, just because it takes you twice as long to catch up. And when we started investing in Pennsylvania, 7, 8, 9 years ago, what really drew us to it is that if you go back and look at the performance during the Great Recession, like, there was like 1/4 of negative rent growth in Central PA, or South Central PA in like 2009, I want to say, and it was less than 1%. And so you weren't necessarily a hero, you weren't gonna just like catch the most high beta market in the world, but it's gonna be durable, and over the long term, like those are the markets where you're really gonna generate cash flow. And now, you know, you look at the components of return, like maybe you don't get the cap rate compression that you get elsewhere, as more because again, that's really dependent on capital flows, which are not
Mhm.
necessarily in those markets, but you know, uh, it's still like a very strong component of your total return. It just backstops you. Like if you make a 10% cash on cash over 10 years and you sell it for what you bought it for, you make 10%. Like, and if that's your downside, like that's not the end of the world.
Yeah, and I feel like that way of investing has come more into favor now than before, right? When debt was cheap, everyone was going bridge to bridge to bridge and trying to focus on trade outs in these rent growth markets and being able to flip in, flip out. Now you're seeing where cost of capital is so expensive, you can't just flip in, flip out anymore. And they're looking at, instead of what your IRR may look like, it's like, hey, what's your year one cash on cash?
Oh
What's
yeah.
your cash yield going to look like? What are the metrics today? That's more in favor now than ever. And kind of like you were saying, like you start gravitating towards these type of business plans and markets. My
Yeah.
question to you though is, are you solving a little bit wider by being somewhere that has less capital flows than like a primary MSA? Are you factoring that illiquidity in, where you're just saying, hey, we're just comfortable with the cash flow, we don't need to sell, and so you need a higher cash yield than maybe what the same property on a primary MSA would be?
Yeah, totally, and that's exactly right, because, again, no free lunch anywhere, and to do any of these deals, you need capital, right? And so how do you, like, raise capital for something that's sort of off the beaten path a little bit, so to speak? And yeah, like, if someone shows a deal with a reasonable assumptions and, like, a 17 IRR in a gateway market, I'm not gonna be able to raise capital showing, like, reasonable assumptions, 17 IRR in this market. Like, you just can't. You have to have something different. And so it's really like solve on the industrial side, it's solving for higher yields. It's knowing the market better than, if you're just like spinning through comps on CoStar. It's like, hey, actually, this deal is like there's paper going out on the lease, and like I know that, and I know where the market is, even if that hasn't printed. It's going to show up in 2 quarters on a CoStar report. But yeah, you got to solve for a higher cash yield. Like if someone I was looking, a friend of mine runs a big firm, and they were saying like, oh yeah, we're developing to a very strong like 6.5 yield. And I'm like, dude, if I showed a 6.5 yield in this market, like no one would ever give capital. Like you
Right.
got, it's it and that's again, it comes back to like what game you're playing. Like this is the game I'm playing right now. I don't want to be buying 50,000 square foot industrial properties in South Central Pennsylvania 5 years from now. But like for now, like this is the game. I feel really good about the story. I feel really good about generating the returns. And then, once this trade, for lack of a better word, is done, we print these returns. We'll see where we're at. But yeah, I think
Yeah.
it, again, if I was running or if I was investing out of a $1 billion opportunity fund, I would not be doing this. It's just this is the game that I'm playing right now, and I'm trying to play that hand.
I mean, they're paid to take very different type of risk than what you're looking at, what we're looking at. It's a completely different
I mean,
business model.
I
So,
did it, and like basically, if you're working at one of these big funds, like you're not really doing real estate investing. Like what you're really doing is like making widgets. And,
mhm,
a pension fund or a sovereign is coming in and saying like, I want like a box of return, you know, and we're gonna say it's an 18 for this opportunity fund. Our target's 18, but like really I want like a 10 or 12, whatever. And I'm just gonna like make that box for you. And I can do it like I'll give you an example on the industrial side. There's a deal that traded in our market. Big private equity firm bought it, their first deal in the market last year. They bought it at a 5.4 cap, brand new 7-year lease, like Class A building, Class A location. And I just remember thinking, like, oh man, like how are they doing? So I asked somebody at the firm, and they basically said, well, we're buying it at a 5.4. We're 50% levered. We got an amazing debt because we're huge. So we have like our cash on cash is like 6.5, and there's 3%, 3.5% rent bumps, and we're going to sell it in year 5, and we think market rent's going to grow more than that. So we're going to have a mark to market story when we go to sell. So we've made, call it like a blended 7.5 cash yield. We're going to sell it at a premium and we'll like back into like a 12. And we feel like there's like our risk of losing money is very low. And that's a completely reasonable business plan for that business. For me, it's illogical. I couldn't do that. But it doesn't, and what I also want to get across is like, me saying this is what I do doesn't mean it's better. It's just different. Like, and again, like the folks who are trading in and out using bridge debt, like that was the right thing to do. Like everyone gives some of these groups, like I think Tides in particular, like gets a lot of guff. Like those guys made a ton of money for a long
They
time
did.
for a lot of people. And, yeah, they, overstayed their welcome a little bit, but again, like I just think if you're saying like this is the one way to do things, like that's just wrong. Like if I had different capital, if I had a different situation, I would not do this. And it's just again, it comes back to like what game are you playing? And I think there's a lot of especially on Twitter and LinkedIn and whatever, it's like this is the one way to do it. Like it's not true. There's a million ways to make money in real estate. But it's just you have to know like what is it like you're doing? Like what are you trying to solve for?
I think that's just a concept that could be hard for other investors to digest, just given the fact that, hey, you got to be good at this one business model to be expert. Um, but I think the way that I look at investing is like a set of principles a bit, and just like having a bit of a constant on the set of principles and then investing accordingly. I don't know. It sounds like that's similar to what you have, where you're dabbling in some multi, you're dabbling in some industrial, you're looking at different markets. You're saying, hey, this might not be the right move 5 years from now. But is there like a constant set of principles or one constant that you do have in investing that you say, like, hey, this investment needs to have this, or this is what I try to look for in an investment, no matter the investment?
Yeah, I mean, the big thing, it just comes down to risk reward, and I think you have to you have to figure out a way to get paid more than the risk you're taking, and that the risk you're taking is different depending on the investment. The reward is different depending on the investment. But I remember my boss at Starwood said, he's like, look at the most successful guys that he like pointed across the bullpen, and there's like in that bullpen, there's a guy who like runs a public company now, the head of real estate at a massive asset manager right now, and guys who've been very successful at Starwood. And he's like, the thing is, like, they'd be successful in any other asset class because they understand risk reward. And I think that's really what it is. It's not like saying, oh, we're gonna, just like renovate this down to the studs, all cash, and like that's our business plan, and like that's other thing. Like no, it's figuring out like the markets change, like what, and you have to adapt with it and figure out how do I get paid more than the risk I'm taking, and that risk changes over time. You can't eliminate it, but like think of it this way. I mean, 10 years ago, we were saying, oh, if I bought a massive office building on Fifth Avenue, you know, and long term leased to a bunch of law firms, like you know, that's really low risk. Like that risk has changed. Same if you owned a bunch of like regional malls, like that risk has changed too. So you just have to stay on top of it. I think constantly be thinking about like, how do I get screwed here? Like
Yeah.
if I see an investment, like if you're me or less so you guys because you're bigger, but if you see something, the first question's got to be like, why am I so lucky as to see this wonderful investment opportunity? you know, just like how do I get screwed? Like think about that
Yeah.
all the time. It's kind of
That's
not a great way to like live your life, but it's like kind of what you have to
no.
do in real estate.
I think the more you invest, the more you focus in that lens. Like for us personally, we have our pipeline meetings, and every time we go through a deal, we're never talking about why it's a good deal. We're always talking about, hey, here's the deal, here's the red flag on it. Like we start with the red flags all the time. And
Yeah.
then if we could get comfortable with the red flags, then we talk about, okay, why it's good. It has this, it has that, it has good schools, it has this. But like the first thing we're talking about is, hey, what are the red flags here? Why, how can we get screwed in this deal? Like, let's protect the downside first. And if we could get comfortable with that type of risk, then we could start digging in and getting excited about why it could be a good deal.
Yeah, and it's just really about process more than outcomes because like there's some things you could have done that during COVID, for instance, like my old boss, I was on the hotel team. My old boss, who I think is like the best hotel investor in the country, launched his fund in December of 2019, in
Yeah.
hospitality. Like,
Yeah.
not a lot you can do there. Like,
Yeah.
there's risk inherent in
Right.
hospitality because you obviously don't have long-term leases, right? So maybe you should have underwritten like that possibility, but you know,
Listen, with that said, if he held on, he's probably doing great. Yeah.
he's done very
Yeah.
well. Like, he's
Yeah.
really, really sharp.
But you're right. That's a scary time.
Yeah, so I think it's just about, you know, you hit the nail on the head. It's getting comfortable with the risk and feeling like you're getting paid for taking it. Like, you just don't wanna be picking up nickels in front of the steamroller. Like, you know, if someone put, like, $200,000,000 in front of the steamroller, like, I'd fucking try to get it, like,
Yeah. Yeah.
but not a nickel, you know?
Right. Right. Well, I want to move on. You are the co-host of the Promote Pod, as I said
I
before.
am.
Love the pod.
Thank you.
It's an incredible what you guys have been doing is how long have you been doing the pod now? Is it a couple years now or
No, I think we are recording our 48th episode this week, so it's been about a
okay,
year.
a year. So credit to you guys. I guess first of all, what originally motivated you for starting a pod? I love to always hear the journey of a fellow podcaster. I'm kind of what was the void that you felt was missing and why did you guys start the pod?
Well, I wish I could take credit for it, but it's really Hiten. So Hiten was former head of
Hitan's awesome.
yeah,
I mean, his flow is great. Yeah.
he's great. Former head of content at The Real Deal, and he left to start 1031 Media. And, his thesis was really that real estate has more characters for capita than any other industry, which I would tend to agree. And real estate's also in everything. Like, every major business story has a real estate angle to it. Like, whether it's, AI is powered by data centers, like whether it's, you know, housing affordability obviously is real estate. So he was doing a great job with the promote. I was an avid reader, and we'd been friends for a couple of years. And he said last winter, hey, like, I've gotten a lot of demand for the podcast. And I'm like, oh, that's great. Like, I can't wait to listen to it. And he goes, oh, well, you're going to be my co-host. And my family's been involved in media. Like, I love media. I've read every, you know, 80s like Disney book, like all of the M&A. So I love the media business. I read Puck every day, and I would never invest in the media business.
Yeah.
But I love the space, and we really felt that real estate. Like, I still think it's really underrepresented in business news. I mean, if you listen to, any of the other big business podcasts, and they'll talk about the real estate market, and they just mean like the residential housing market for the most part. And no one really, like, I felt, was digging into like this discrete real estate topics, strategies, characters. And Hiten has done a great job of that on the promote, and we've tried to bring that to the podcast.
Yeah, I love how you guys bring the characters to life, so to say, in CRE. And we always talk about the markets and the trends, but when you're looking at deals and you're like, "Oh, who's selling that one? Oh, why are they selling it?" And like the whole
Yeah.
saga of real estate. I love how you guys bring that to life and make make it almost like a drama film, so to
Yeah.
say,
I mean,
of
you
real estate,
you're in
reality TV show.
Yeah, I mean, you're in the business, like, how nuts people are here. But I mean, if you're just buying a stock, you click a button. If you're buying a bond, you click a button. Like, the thing about real estate, which is so great, is that, whatever you can do anything you want as long as you can get the other guy to agree to it.
Right.
And, that's just missing in other asset classes. And I'm sure, and we deal with such crazy characters in here because it's an industry where a lot of people are in it without being professional real estate people. And, like, I remember touring a property, bought this multifamily property for like 19 million bucks, and the broker's not there for the tour. The guy who owns it's there. He's wearing jean shorts. It's February, and he's like telling me I don't need to sell. I'm like, okay, like, I'm happy to, we can wait, whatever. He goes like, no, 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 I don't need to sell. And he shows me a Schwab account with $12 million in it. He's like, I'm rich. I don't need to sell. I'm like, okay, like, I believe you. And like, that's not going to happen if you're, buying shares of Apple.
Yeah. One trend I'm noticing is like in our generation and as CRE becomes more institutionalized is I feel like the characters are there's becoming less of them as it becomes more institutionalized and you have these big players where it's like faceless names of 500-pound gorillas. How's your take on that in terms of the fact that we are in an industry that's becoming more institutionalized. Do you feel like that trend is also happening, or is it just looking different than it used to with the cowboys all buying whatever they want to buy?
No, I think you're exactly right. I think the days of, David Willentis buying like Dumbo for, $12 million, like that's over. Like you have to have such a balance sheet at this point to do stuff at scale that, you know, the Harry Helmsleys, the David Willentises, like the, you know, the Cousins properties, like those types of guys, like it's just a lot harder. That said, I do think it's probably the best time to be a real estate entrepreneur, at least since I've been doing this, because the way the market's going is like you have to be one of two things. You have to be the 500-pound gorilla, so you've got to be a Blackstone, you've got to be a Brookfield. I mean, even some of the firms that we talk about this in the pod all the time, like AUM gobbling. Like there was an article in the FT a couple of weeks ago about some really big private equity firms that like can't raise new funds or are raising funds at like half the previous size. Like Madison Dearborn. Like when I was in college, like Madison Dearborn was you know, one of the most prestigious PE firms that you could potentially get a job at. And now they're talking about like that firm like might not be able to raise another fund. So you've got to be one of those firms that can go raise, you know, essentially unlimited money, or you've got to be the exact other thing. You've got to be like, we're the sharpshooter. And what we're going to do is like, you can create a whole business and a really successful business around just like running the stuff that they have to buy. I mean, I'm like pretty candid. Like my strategy in South Central PA is literally to put enough assets together to like go sell to one of like three firms who are like, I like
Yeah.
this market a lot, but I'm not going to incur the brain damage. It's not literally not worth my time to get out of bed and, write $3 million equity checks into these smaller deals. But like, I'll write a $40 million equity check if you can put together 9 of them, like that's what my whole business is. And I think that's sort of that opportunity set's really ripe. It's not just in my market. It's not just in my asset class. It's across the country. And if you can figure out where these firms need to be and like what's institutionally acceptable, like you can go build really, really strong businesses based on performance. And so I think it's the most exciting time to be a real estate entrepreneur, in the last 10 years.
Yeah. I mean, going back to that, like I love the play. I know we're going back to like business strategy, but like the play of buying something that's like sub-institutional, quote unquote, and making it institutional, where you're not just banking on the type of rent growth or the as is value and speculating, but you're creating it into some institutional vehicle or some type of asset that has higher demand or higher capital flows for that asset
I
because you
mean,
get the cap rate compression on the back end as well.
yeah, I mean, I've seen it. I mean, if you go read like the Trammell Crow letters or anything, like multifamily wasn't considered really institutional in like the late 80s, early 90s. I mean, that's part of why
That's true.
that's why the REIT industry took place, is because people couldn't like capitalize their portfolios. And even just on my side, like I think back to at Starwood, and this is like 2014, 2015, we were buying like nice select serve hotels in good markets. So like really good Hilton Garden Inns in like good markets in the Midwest and the Southeast, and we're buying like 11 caps, 12 caps. And again, that's not just saying like, hey, you were the smartest people, like we saw this coming. Like, well, we were backstopped by cash, right? Because if you're making an 11 and you're
Hmm.
financing it at 6 or even 7, your cash on cash is really like mid teens. So we're like, okay, like that's the downside scenario. Like we're cool, but we think that select serve is a better business than full serve because the NOI margins are higher. And at some point, like capital is going to figure that out. And like that's exactly what happened. And that's happened in industrial. Like industrial 15 years ago, like not really considered institutional. Like go look at which markets or which private equity firms like were, if they're raising funds, like what was allocated to industrial, it was not very much. Like 5 years ago, data centers, like that wasn't really considered institutional. And
Right.
now like Starwood's new fund is like 25% data center. So if you can figure out
Self
where the
storage was
self,
there.
yeah,
Yeah.
that's a great example.
Yeah.
And these are all things like you don't need to be a genius to like figure those out. You can all you got to do is like follow the CRE news, and you'll see like where people like John Gray's running videos will tell you. Like
Yeah.
on LinkedIn, they're like office is 2% of our portfolio. Like we're really focused on logistics, housing, and what like you can figure this stuff out. And again, if you're an enterprising young person, you can go like run the ground game, figure out where like these assets are, and put them together.
And on that note, after doing the pod for a little over a year now, have has your investment thesis changed a bit or a different perspective changed just based on how into it you are with putting up podcasts and talking about the market and um, if there is any lens that's changed, like what has changed in your view in these past year from doing the pod?
I mean, I think the big thing is you have to you have to figure out what you are. Like, what is your business? I've said this a lot on this podcast, but it's because it's the thing that's become most clear to me over the last years. Like, what
Right.
are you? And not just like, why would someone invest with you? But like, what are you trying to build? Like, are you trying to build a business that gets puts together a lot of AUM? Like, that's totally fine. Are you trying to build a business where you put up a lot of your own capital and shoot the lights out and keep the lights on with some small investor capital? Like, that's totally fine too. So you have to figure out what you are, and then because if people can tell, I think the reason why our podcast has taken off a little bit is because we're very ourselves, and people can tell if you're not being authentic. And I'm sure we've all been this too. If you're like pitching an investor and you don't really believe it, like they're not going to believe it too. And people can just smell it. They're not going to be able to necessarily put their finger on it, but like they can tell. And so doing the podcast, I think, has really just solidified the fact that, you know, it's not about what asset class or what geography. For me, it's like whatever I'm doing, I have to really, really, really believe in it, because that comes across. And that's really been the biggest takeaway for me.
No, you're absolutely right. I've said this before on some previous episodes, but like you got to die on that hill for whatever type of investment thesis or deal that you're pitching. You have to really have conviction, especially in this time in the market. Conviction is the only way that you can generate alpha and asymmetric returns. Because if you're just going with the flow and going with what the crowd wants, you're not going to really be different than what the other, commoditized groups are doing and what the big 500-pound gorillas are doing as
Yeah,
well.
you don't have their you're not going to have their advantages. Like if you saw the debt that Blackstone can get on multi, or like how they can get Fannie and Freddie, like give them stuff on their debt docs, like you wouldn't believe it. It's impossible for us to get that, And so you're just not going to be able to compete if you're doing the same thing. I'll tell you a quick story about baseball because I was a professional baseball player for 5 minutes. So I remember I had a teammate in college who came back in the off season. He was playing in the minors, and there was he was playing catch with this is in Florida. I went to Rollins for my MBA, and there's a bunch of pro baseball players in Orlando. And so Zach Greinke, who was a pitcher for the Royals, like he won a Cy
Yeah.
Young, he was a Hall of Fame character. So he would come to our practices and play catch with this guy. So he was a minor leaguer uh, who graduated the year before. And so he's playing catch with Greinke, and Greinke's like, "Are you throwing any bullpens? Like, what's your program?" He goes, "Oh, I just do what what the team, like the program they prescribed to me." And he goes like, "Oh, so you're doing what everyone else is doing?" And he goes, "Yeah." He goes, "Are you that much more talented that you can do what everyone else is doing and still make it?" He's like, "No." He's like, "Hmm." And
Wow.
yeah, and I just thought that was like that's great. It applies to everything.
Yeah.
It applies to so many different things. Like if you're sitting here and you're like an emerging manager, you're like, I'm gonna invest in Austin. Like, unless you live in Austin, have lived in Austin, like have some sort of unfair sourcing advantage or unfair, like your best friend is the county taxing authority guy who's like going to cut you a break. Like you're not going to be able to generate the returns. Like, you're just not.
Yeah.
Like, and you got to figure out a different way. It doesn't mean you can't do that type of business eventually, but all of these huge private equity firms, they were built on the first fund or two that were small and outperformed, and that can stick around for a long time. Like the one I always mention is like Westbrook Fund One, which was the Morgan Stanley real estate guys, and this is like the mid-90s. Fund One was like a 28 or something, and it launched like 10 firms, you know, and all on the strength of that. And like even Starwood, I mean, Starwood was launched because Barry was buying multifamily for cash during the S&L crisis and like financed it out and sold it all the equity residential for stock before it went public. But like that was a contrarian play. Like people thought like multifamily was not institutional. And, if he'd gone and just tried to buy like malls or big office towers in the Mag Mile, like wouldn't have outperformed. So you have to do something different if you're at the start of your career. Like again, it's like playing a different game than being later on. You know, it's like when everyone watches LeBron's workout videos and they're like, why is he doing like the insane Bosu ball squats? Like, why is he not like LeBron doesn't need a deadlift. Like if he gets hurt, like that's way worse. Like he just needs to
Yeah,
not get hurt when he's working
yeah.
out. Like the risk profile is different. So you just have to know like
And
where
even
you are in
him,
your.
he's doing even him, like, if you talked about his training program, like, he probably takes care of his body more than anyone
Oh
else in
yeah.
the league, and look where he's at, and so
Yeah.
you're right.
But
Just
like
like what
if
Granky said, like, you've gotta do something different. You gotta do
yeah,
something different, and you gotta be better in that regard.
yeah. You have to do something different because to definitionally generate different returns.
Amen, amen. Will, this was awesome. Great banter,
Yeah. No, thank you for
to
having
have
me,
you
David. This
on.
was a pleasure.
You're also just like a natural at this point on the podcast forum, so
I've had
this
a
was easy.
I've had a very good coach in Hatan.
Yeah, yeah, exactly, I could see it. Well, looking forward to continuing listening to you and Hiten at, the Promote Pod and 1031 Media. Keep crushing it, and it was nice to take a step out of the Promote Pod and hear a little bit about how Will's investing in deals. So
Well,
great to have you on.
yeah, thank you so much. This was a lot of fun, and congrats on the pod, and look forward to doing it again.
Awesome. Take care.
See ya.